Hello, everyone. We are Bronco Asset Management from the University of Poly Pomona, and we want to thank you for inviting us here today. My name is Ison. Here we have Flavio, Victor, Jez, and Angel. So starting off, we are presenting a sell recommendation for Houlihan Lokey with a target price of $85, representing a 12.2% downside as of February. We believe that Houlihan Lokey is a sell because, one, management's inorganic growth strategy could prove harmful to the company. Two, weak M&A and fundraising activity could inhibit corporate finance's profitability. And three, Houlihan's voting trust holds approximately 80% of the voting power. Houlihan Lokey operates three segments: corporate finance, financial restructuring, and financial valuation advisory. Corporate finance accounts for mergers and acquisitions advisory and capital market offerings. Their second segment, financial restructuring, provides advice to creditors in connection with recapitalization and deleveraging transactions. Their final segment, financial valuation and advisory, provides valuations of various assets. Furthermore, management's inorganic growth strategy could prove harmful to the company. Their most recent acquisition, GCA, was bought at the peak of the technology bubble in 2021 for $600 million. That's $400 million above GCA's 5-year average enterprise value, or 35 times GCA's earnings. It's interesting to note that GCA's earnings have decreased by 2% per year for the past 10 years. We believe that Houlihan's decision to purchase GCA could damage their reputation as a leading M&A and valuations advisor. A weak reputation could have a material impact on their market share position. Now I'm going to pass it on to Flavio, who will speak about the industry.
Houlihan Lokey operates in the global investment banking and brokerage industry. Now, with the reopening of the economy and low interest rates, we saw an increase in corporate finance and M&A activity in 2021. However, high inflation and geopolitical tensions led to a decrease in M&A activity in 2022, and is also expected to persist into 2023. Now, our research indicates that dry powder has significantly decreased about 34%. And this is because Houlihan Lokey's client mix, private equity firms make up 40% of it. Therefore, these firms have less capital to engage in M&A activity. Also, interest rates are expected to remain high, which can further discourage these firms from issuing bonds, which could lead to a decrease in asset values and also ultimately discouraging them from raising equity. Moving forward, although we may see an increase in financial restructuring because of the overall decrease in net working capital in the industry, we believe that financial restructurings will not fully offset losses in M&A activity, as most of the principal payments are due beyond 2024. That is why we believe that financial restructuring will increase moderately, and therefore it is essential for Houlihan Lokey to find new avenues of growth, as financial restructuring accounts for less than 30% of its overall revenue. Now, with this overview in mind, Victor will now go over the financials of Houlihan Lokey.
Thank you, Fabio. When you look at the three revenue segments of Houlihan Lokey, you'll see that corporate finance makes up nearly 70% of their overall revenue, especially in fiscal year 2022. Now, with everything that Flavio said in mind about the industry for M&A, we do see that corporate finance's revenue will decrease significantly compared to 2022. We do think that financial restructuring is likely to grow during the slowdown. And as Flavio mentioned, it is a smaller revenue segment. It's not going to be enough to offset the corporate finance decrease in revenue. For financial and valuation advisory, we do believe it will slowly grow, but it will be held back by a decrease in M&A deals because that segment helps with fairness valuations of M&A transactions. In terms of earnings and dividends, we do believe that earnings will likely suffer because of an increase of managing directors and employees via acquisitions. We do anticipate a 5 to 10% cut in jobs, which could help slightly offset employee compensation costs. But again, with their decreasing revenue, we don't think it's going to be enough to offset a lower earnings. So for dividend growth, we do believe that it will slow in comparison to historical growth. We are projecting it to still grow, just not as fast as historical. I'll pass it on to Jez now for ESG.
So here we have Houlihan's management team. As we can see, they are lacking diversity. And throughout our research, we found a positive correlation between gender diversity and organizational health, which leads to better business performance. As we can also see, Houlihan's team is nearing retirement age, with the average tenure being on the team being 15 years. With Houlihan having no plans for succession, we believe that this will cause problems in the future. Another problem we found with Houlihan was with their voting trust, which holds approximately 80% of total voting power, leaving the Class A shareholders with no say. Houlihan is also considered a controlled company, which allows them to opt out of certain corporate governance requirements. Having good governance in a company is important, and Houlihan has a poor governance score. They are also lacking in the environmental and social aspects of ESG. To further support our argument for questionable governance, we would like to bring to light a scandal that took place in 2021 involving an executive member. This executive was accused of giving out privileged information and putting his own personal interest in front of shareholders' interest. He was not reprimanded at all for his actions by Houlihan, which further supports our argument for questionable corporate culture. Overall, Houlihan's entrenched management lacks diversity, gives shareholders no rights, and has questionable practices. Next, I will hand it off to Angel to go over valuation.
Our target price of approximately $85 per share was derived by taking the weighted average of our three valuation metrics, which included a dividend discount model, discounted cash flow model, and relative valuation. Our dividend and cash flow models received the majority 80% weighting of this allocation because we believe that these intrinsic models best capture Houlihan Lokey's fair value. Relative valuation received a weighting of only 20% because we believe that analyzing companies on a relative basis implies that the market is correctly pricing in each of these different businesses. However, we still wanted to include it to understand where Houlihan Lokey stands relative to its industry peers. Utilizing CAPM, we calculated our cost of equity of 7.9%. We used the 10-year treasury as our risk-free rate at 3.6%, calculated a 5-year regression beta of 0.79, and utilized Dr. DeModern's ERP model to calculate an equity risk premium of 5.5%. We believe that the risk-free rate is a good proxy for terminal growth. Therefore, we employed a 3.5% terminal growth rate. Understanding that terminal growth and discount rate are the most sensitive inputs in our models, we conducted a sensitivity table to show various combinations of terminal growth rate and sensitive discount rate would affect this model. As we can see in the majority of instances, Houlihan Lokey is trading at more than fair value. Again, utilizing now our discounted cash flow model, we this time discounted by the WACC of 7.8, again using the same terminal growth rate of 3.5%. Again, we have included a sensitivity table to show that in the majority of instances, based on the combinations of terminal growth rate and discount rate, Houlihan Lokey is trading at more than fair value. We finally conducted relative valuation and compared Houlihan Lokey to industry competitors such as Stifel, Jefferies, and Evercore. We looked at metrics including price to book, price to cash flow, and enterprise value to EBITDA. As we can see, Houlihan Lokey is trading at a premium relative to the industry competitors. So what we did was took the premium took Houlihan's multiple, returned it back to the industry median, and based on the valuation weight below, derived our target price of $77 according to relative valuation. As Houlihan Lokey continues to grow its presence globally, we believe they will face significant risks, including unfavorable market conditions, financial regulation risks, and inflationary risks. We believe that management needs to be on top of these specific risks as it could hurt Houlihan Lokey's growth moving forward in the future. Finally, putting all these points together, my team and I would like to reaffirm our recommendation of a sell with a downside potential of 12.2%. We believe Houlihan's inorganic growth strategy, paired with weak M&A and fundraising activity, will continue to harm the growth moving forward. In addition, we believe that the fact that the voting trust holds approximately 80% of the voting power leaves the public shareholders without any say in the direction of the company. We would like to thank you, and now I would like to open the floor to any questions.
Give me 1 sec to reset my time. All right, whenever the first of you goes. Okay. Well, very well job, good job done. What do you view as the single biggest risk to your thesis that could prove it possibly wrong? Just to play devil's advocate.
I think that the biggest thing would be if M&A activity actually picked up in 2023. The second biggest thing would probably be if the voting trust actually, if there was a way that they restructured that, basically, if shareholders had more rights, basically.
So I'm kind of curious because, it's logical that M&A probably will slow down, but what are these other competitors gonna do? Because you talked about how they would probably need to find new avenues of growth. I'm just trying to kind of figure out where they could do that.
Actually, their competitors have been allocating capital to businesses that generate stable income streams, businesses such as asset management, wealth management, while Houlihan Lokey is focused solely on its M&A business.
Okay, so that's more the private equity side. Okay.
Good job. And I wanted to ask, you mentioned on the ESG side, the ENS was also weak. So Jess, could you talk about that or anyone else?
Yeah, so in their environmental and social, based on Bloomberg, their disclosure score is still lower, and relative to their peers, it's lower as well. You can actually show that on the appendix. Yeah.
As a follow-up, I'd like to know your and the team's opinion on it. I understand that the Bloomberg scores are low. What do you think of it?
Of the environmental and social scores?
And the governance that you talked about, yes.
Well, we're mostly focused on their governance score because that's where we see our main issue. And as you can see, Houlihan has an ESG score of 10, which is the worst score you can get. And based on like their voting trust and their questionable practices, we believe that it's a negative for Houlihan.
Just to comment on as to weak M&A activity, I understand and I respect the comment about capital being raised in 2022 is very low given the market environment. But can you comment on the amount of dry powder that is still out there? That if you think about these private equity funds and firms, they're going to have to try to start putting this to work. While they can slow it down over the course of maybe 6 to 12 months, eventually they got to put it to work. Would that not be a tailwind for Houlihan?
Yes, there is still dry capital available for these private equity firms. But what we're seeing is private equities really become this bubble where every investor has been allocated capital to this business, lowering returns. So investors will ultimately start reallocating or rebalancing their portfolios.
Can you talk a little bit from an industry perspective, what their actual market share is? Because I feel like they are kind of known as a leader in the space. So I'm just trying to understand that.
They have a 0.56% market share. Their competitors are around 2%, 0.8% around that area.
Okay, so it's a real fragmented space.
It's very small.
Definitely.
Okay.
You talked about the GCA acquisition.
Yes.
Did you look at other acquisitions? Why did you choose to focus on this one?
So
in particular?
GCA was one of their biggest acquisitions to date. Historically, they've made really small acquisitions and they haven't really been a story there. But with GCA, again, they are a European-based tech-focused M&A investment bank. And so we think that Houlihan Lokey's timing of the purchase was not the best. We also think that they overpaid for it. And lastly, for between that acquisition till now and beyond, we do think that M&A activity in that sector, in that area geographically, will not pick up probably as they anticipate.
Given that the firm, you correct me if I'm wrong here, went public relatively recently, how do you expect that to change? And I'm thinking from like ESG's perspective and the comment about them not having the diversity that you would look to see. Do you see that as maybe something that will help them change or bring in new people to incorporate more diversity into the organization?
Well, I think that's the biggest thing. So they've been public since about 2015.
Okay.
And so, between 2015 and now, they still haven't had a lot of changes in management. So I don't know. I mean, there is more of a push industry-wide for ESG, so that might help. Jez, would you tell me that?
Yeah, and just throughout our research from papers we found through McKinsey & Co., we did see a benefit with gender diversity and organizational health, which leads to better business performance. So we think that we're not sure when they're going to add women in management, but once they do, that could be positive for them. But like we said before, they haven't done that yet.
Yeah, I'm kind of curious about kind of their team because I'm looking at Appendix 4.1. Just looking at the income statement, and obviously compensation had to drop pretty considerably. When you look at the executive comp that was paid out, pretty sure they're cashing in because some of them were 8 figures. So how do you see, the employee compensation? Because you've got a pretty big drop off in 2023, 2024. Do you see that being a peril, a danger for them?
Yeah, so it's two things. So the drop off is basically, they did add a lot more employees via acquisitions, but because investment banking and individual employee salaries are based on the deals, the volume there. So the drop off is basically kind of like what we're seeing with the industry going down. So as like we said, corporate finance revenue will go down significantly compared to fiscal year 2022. We think that their overall salary is going to go down as well. And on top of that, we did add that they probably will have to cut some jobs as well. And so that's where the decrease in employee cost.
If you were the CEO and you saw this recommendation, how would you counter it?
I think that the counter would be, historically management has done a really well job. They do have a good name in investment banking. They are the lead boutique investment firm, one of the best names historically. So I think that the CEO would say, look, our track record's really good. M&A activity might pick up sooner than we think. And I think that's kind of what they would say.
If you could, sorry, go ahead.
I'm going to push back on that. That's all backward looking. This is a forward looking recommendation. So
well, the M&A is forward looking as well. So what I'm saying is that I think that they would say, look, historically we've done really well. We're going to continue to do really well. I think that they would push back on the voting trust because since they own the voting trust, they would most likely say, look, like we know what we're doing. We have plans. Maybe they have plans for succession that they just haven't announced to the public. So if they were to push back, I believe that's what they would say. Like they kind of know what they're doing. They know it's in their control, and they believe maybe they have a different outlook for the industry than we do.
thank you.
Do you, if you can handicap an estimated timeline as to when you expect your price target to hit, what do you think?
It was probably roughly, it's about 1 year price target, so 12 months.
And if you can, sorry for the quick follow-up, but if you can estimate how much of that you would expect just be from general market conditions and from their underperformance, what do you think?
Well, we've seen historically the markets right now are still on edge. Inflation is still much higher than expected. So we believe it most likely will probably happen with the market, maybe not specifically just because it's Houlihan Lokey, but as the general market, especially because they are in the investment banking business, it should follow most likely what the market is.
Can you re-explain, because you may have already done this, I apologize. On
2
your-
minutes, sorry.
Okay. On your valuation models, you weighted DDM and discounted cash flow at 40% and kind of threw in the relative valuation, but you kind of explain the weightings again.
Yeah, so we gave 40% to eat both discounted cash flow and dividend discount model. We believe these are like, because these are intrinsic valuation methods, there's no, I guess, outside factors that would, there obviously is outside factors that would influence these, but because we are able to, project our cash flows, project what we believe future dividends will be worth, they gave us a concrete number of what each share of Houlihan Lokey should be worth. Relative valuation, again, received only a 20% allocation because we believe when analyzing companies on a relative basis, it's implying that the market has efficiently priced in each of the specific competitors, but we still wanted to include it because we want to see where Houlihan stands. So the point of underweighting relative valuation is just, we're not sure if the market is maybe just overvaluing certain competitors and undervaluing others. So we wanted to give it only a 20%, but we still did want to include it.
Got it. And is the PE ratio kind of on the high side compared to?
So we actually looked at enterprise value to EBITDA. And as we can see, the industry median for the competitors listed is about 10.5. Houlihan is at a 14.5% multiple, or 14.5 times multiple.
But I would say the PE is generally higher than the.
Okay.
I see that you'll have a Porter's 5-force analysis in your appendix. Could you talk about how that factored into your recommendation?
That's right, yeah, so taking in the factors that we analyzed here, we do believe that the threat of substitution is a factor here. Also competition in the industry, right? It's a big industry. You have lots of banks, so at the same time, your bargaining power of suppliers, you have the workers, right? We are seeing
Make that a lot louder. Sorry.
All right.
Thank you.
Thank you.
Hi everyone, we are Highlander Financial Group representing the University of California, Riverside. Today, we're excited to present our findings on Houlihan Lokey, an investment banking firm based out of Los Angeles, California. We are initiating coverage on Houlihan Lokey with a buy recommendation based on an intrinsic price target of $104.01, representing a 6.5% upside to the closing price of $97.71.
HLI has three segments for its revenue. First one is corporate finance, then which is about mergers and acquisitions. Then we have financial restructuring, which is about demergers and liquidation. And the last one, FPA, is for valuation, opinion, or services. As we can see in 2022, corporate finance is its major revenue generating segment with 70% of its revenue. The other two segments account to 30% in total. And as we can see in figure 2, we see financial restructuring is actually counter-cyclical because in 2021, just when we were seeing the financial impact of COVID, that is when they show higher revenue. That would be the middle one in the middle part.
Moving forward to industry overview, we can see in figure 1 that global M&A transaction value and volume have declined all throughout 2022 due to aggressive monetary policy. We can also see in figure 1 here that global deal count has declined for corporations and sponsor-backed firms as liquidity and valuations have fallen, which has decreased the demand for acquirees listing their public companies for sale. As we move on to figure 2, rising rates impacting global inflation impacts how firms finance their mergers and acquisitions. According to PitchBook, cash financing has been the main source of acquiring a firm, as the cost of debt prior to 2022 has remained relatively low. However, given the current macro environment, we're experiencing an uptick in corporations utilizing equity finance to finance their deals as rising debt levels may pose a risk to the financial health of the firm.
Moving on to competitive positioning, we can see that HLI has a wide economic moat that is defended by its deep bench of talented advisors. Looking at the first table, we can see that the HLI has been a restructuring advisor for some of the largest bankruptcies in U.S. history. Moving into the second figure, they have prioritized the diversification of international revenue by moving into different geographic regions, by acquiring middle market investment banks, merging those synergies together and folding them into their current business model. We believe as a team that this is an effective strategy for them to drive their business growth. And lastly, looking at the D to E ratio comparison, HLI stands to have the most marginal level of debt compared to all competing M&A advisors.
Moving on to the investment summary, HLI's focus on mid-cap M&A transactions, which are not expected to decline as greatly as the overall M&A space, will shelter their revenue during a potential shallow recession in 2023. Similarly, in figure 2, we can see HLI's dominance and deal volume against both bulge bracket and middle market investment banks, which should still give them steady deal volume in 2023. In figure 3, we can see that in 2021 and 2022, the number of bankruptcies declined. However, in 2023, we expect this number to increase, giving HLI revenue from financial restructuring. HLI's weathered management team has positioned the firm to outperform their competitors during times of low economic activity.
Moreover, HLI is strategically positioned for international growth. As seen in figure 1 here, HLI has acquired 5 international firms since 2015 to increase their exposure to Asia and Europe. Resultingly, as shown in figure 2, they're positioned to grow as they've been able to expand their European investment banking team by 225%, which has resulted in them positioning to take on a $1.8 trillion European M&A market to grow their 1.3% global M&A market share by middle cap.
Moving on to the financial analysis, HLI, we believe that forecasting a decline in macroeconomic conditions going into this year, they're going to see a lag in the volume of deal transactions going into their pipeline. We can see over the last 5 years that they've gradually increased their revenue, being a beneficiary of that lower interest rate environment. The firm's biggest expense in the income statement is the operating expense, which is employee and compensation benefits. This is largely, it's like you pick the best talent, better pay them the best. And then going into, they have a strong track record of liquidity, increasing their liquidity and long-term solvency. They've increased their liquidity by 2% and their solvency by 1.3%.
Moving on to valuation, we calculated our intrinsic value through taking the weighted average of the three valuation models from the three intrinsic values from our financial models. We started off with the discount dividend model, with the dividend discount model. Next, we use the discounted cash flow model, where we use the perpetuity growth method and the exit multiple to find our terminal value. And lastly, we used the comparable company analysis, where we used a pure EV to EBITDA multiple. We then took we put more weight at 70% on the DCF, and then we used a 15% weight for the DDM and the CCA. The reason we went heavier on the DCF was due to being able to forecast the advisory services that Houlihan Lokey provides, as well as taking consideration of the macroeconomic events that impact Houlihan Lokey's business segments.
Our intrinsic price target for our DCF model was a weighted average of the terminal value methodologies. We did an equal weight towards the perpetuity growth model and the exit multiples methods to comprise our intrinsic price target for the DCF of $105.21.
For comparable company analysis, we chose HLI's competitors as PJT Partners, Evercore, Moelis, and Piper Sandler. The reason we chose these competitors is because they have a similar operational structure and P ratios. So we took the average of their competitors' P ratios, and we did three scenarios. The best case, we weighted that at 25%. Going with a conservative approach, we weighted the base case to be 50% and the worst case to be 25% as well. So with that calculation, we see an upside of 5.05%.
And next, we had the dividend discount model. We calculated the intrinsic value to become $102 per share, with an average growth rate of 11%, forecasting out 5 years due to a strong balance sheet and a low payout ratio of 33%. We expect Houlihan Lokey to continue to pay out dividends, which will cause a higher payout ratio, and allow a dividend discount, an average ratio of 70%. And then moving on to ESG, Houlihan Lokey is a firm that is working on sustainability throughout its global operations. It prioritizes social awareness through its diversity, equity, and inclusion, through its DE&I Council, as well as enforcing DE&I in the workforce through its 5 diversity organizations. However, Houlihan Lokey needs to work a bit on their governance. One of the main factors would be Houlihan's voting trust, owning about 78% of the voting power, which can be and can cause for concern for investors. Secondly, Houlihan Lokey needs to expand their gender diversity, as their management team is all male. And lastly, Houlihan Lokey needs to change the auditors, as they haven't changed their auditors for over 16 years, which can be a cause for concern and can be considered a risk.
The greatest emerging risk is the tightening of monetary policy. As interest rates rise, M&A activity declines, which is Houlihan Lokey's largest revenue segment. Another major risk is, as Houlihan Lokey acquires more firms overseas, they have to ensure that they are making proper integration, as well as succeeding to the regulatory issues that come with them.
To summarize, we would like to state that from our analysis, we think we should buy the stock with a 6.05% upside and a price target being $104. The reason would be the strength in opportunities. As we can see here, HLI is the market leader in mid-cap transactions. They have huge deal volumes as compared to their competitors. And also they have a wide coverage of industries, and they ensure this by hiring new managing directors from outside the firm. They also have countercyclical business, and they're very good at financial restructuring, which works well for them. And the last one, but not the least, being their international growth, which enables them to have a big market cap. In conclusion, we would like to say our decision is to buy, and thank you for your patience here.
Hold on. Let me reset my timer. All right, as soon as you guys ask the first question.
Okay.
Should I start?
Someone else,
Sure.
sorry.
Sure. When you talked about the auditors, you said that they had been there for a long time and it'd be good for them to change. Was there anything in their financial analysis that you saw or in the auditor's notes that gave you pause? Or how did you yourself evaluate that?
So I did a research on Google that the normal amount that a business should be switching auditors is roughly 5 years. And it's about 5 to 7 years, and Houlihan's been more than 16, which kind of is a cause for concern as we don't want any discrepancies that, if you're reading the same kind of financials, you're getting like accustomed to them. So having that switch out would be beneficial for other investors to have certainty that there'd be no discrepancies in any statements.
How did you factor that into your analysis was my question. I understand why, and thank you for that great explanation of why auditors should be changed. How did you factor that knowledge into your analysis?
Thank you for the question. We ended up factoring, so although we did consider a buy for Houlihan Lokey, we did say they need to improve their governance, and we ended up using a conservative approach when we're making our DCF model. So I would say we definitely cut down. I would say that we didn't. So we factored it through their revenues, but we didn't cut them down too much because they don't affect the actual business model and their profit making strategy. But it is something that they do need to improve down the line.
I can go really quick. When I was looking at your dividend discount model projections on 15 in the appendix, can you help me kind of understand where you grabbed the dividend growth rate? I know you went 3 different stages, but what had been kind of historically their dividend growth rate, and what made you comfortable to kind of go with an 11%?
Sure, currently they have a 2% growth rate, and we forecasted that they were going to have an increase in their dividend about 7% down the line after the 5-year projection.
Kind of to add on to that, we did a historical just CAGR of the entire dividend history since 2015, I believe, when they started going public. And the CAGR that we got was approximately around 9 to 10%. And we think they're going to sustain that rate moving forward, especially since they actually raised their dividend during 2022 during a rising interest rate environment. And we think that that really shows how strong the firm's balance sheet is and their ability to withstand macro headwinds. And because of that, we really forecast that within the next 5 years, their CAGR for their dividend growth rate is going to sustain around 11%, then taper down to 7 or 9%, then to perpetuity growth rate around 7%.
So it sounds like you accept the argument or think that, corporate finance, which is 70% of current revenue, may experience some headwinds given the changing macroeconomic environment. And then you comment that financial restructuring is countercyclical, and I agree with that. My question would be, currently, given that financial restructuring is only 17% of their revenue, do you think they have the ability, I guess, internally to ramp that up to offset any weakness in corporate finance?
Yeah, so we believe firmly that they have like a large talent base to be able to expand and cover that financial restructuring coverage. Mainly because they really focus on they have like a different set of teams that specialize in each of those categories. Like you have your M&A advisors, you have people who focus specifically on the restructuring, and then they also provide the fair valuation opinions, which have been very more lucrative to compare to restructuring over the last 5 years. I would say that in terms of addressing the restructuring, expanding that business, they're undergoing that with this inorganic approach of acquiring other M&As that specialize in that as well.
Can you talk a little bit about kind of from an industry perspective, where they are from a market share, and are there other competitors that might be doing something different or have other revenue streams that there might be a risk to them not keeping pace?
Yeah, that's a great question. So based on our analysis, especially looking at the investor relations page for Houlihan Lokey, they have a 1.3% global market share within the mid-cap space based on deal count. So in terms of deal count, in the mid-cap space, which is $1 billion or less, makes up 98% of total deals done in 2021. So their total addressable market makes it a great opportunity for international acquisition. So if I were to say what makes them stand out from an industry perspective, it really has to be their international acquisitions, which allows them to expand into this $1.8 trillion market, as well as their ability to grow and acquire firms, because they're currently the leader amongst bulge brackets and middle markets in deal count. And we think that the consistent revenues within the mid-cap space will generate flows, especially during a down market.
And then, do you see there are other competitors doing anything differently that they might want to consider, or do you think that they're doing everything they can?
Their competitors actually, if you look at the bulge bracket ones, they of course offer more services because they are bigger firms. But HLI is more, it is more streamlined. They are especially known for the financial restructuring, as we saw in one of his slides, that they have done their restructuring during bankruptcies like Lehman Brothers and all the big companies. So they really, they have the expertise of, they're good at what they do is what I'm trying to say. And they're probably the best in the market in what they do. There are firms which obviously provide a lot of different varieties of services, but again, just by going by the fact that the deal count is the best in the deal count, even compared to other big companies which are doing the same business, shows us that they have that pipeline of clients. It's just that they're not at the top because their deal value isn't as big as big companies.
Thank you.
And to add on to that, the reason why we decided to go with these four main partners compared to like Raymond James and Lazard, they have a big asset management branch, which makes them over diversified. And I think the specialization for Houlihan Lokey within the mid-cap M&A space makes them a global market leader. And I'm sure many recruiters, they try to target those top talent because they know that Houlihan Lokey is going to sustain being the best firm, and they've proven it year in and year out.
You talked about their restructuring business and how that's, anti-cyclical. Could you talk about how the current market and the interest rates are affecting financing and how that factors into your analysis?
So we actually pulled up some PitchBook data explaining how cash financing and stock equity and the blend between the two. So I didn't put on here, but the actual the most common form of financing is actually a blend, a combination between stock and equity. But as you can see, cash financing has declined over the past year, in particular in 2022, and that's directly correlated to rising interest rates, and companies are being more conservative with their balance sheet. And stock equity, since we've seen a massive rise over the last 10 years in the bull market, many of these companies are trying to finance through equity, and we think that that trend is going to continue, and we're going to see a shift from cash finance to stock equity moving forward because of the current macro situation. But however, we believe that prior or after 2023, we see the economy maybe entering a shallow recession, followed by interest rates cut, which we believe will increase cash financing following 2023.
In terms of their acquisition record, it looks like they've purchased 5 different companies in 5 years that they've been public. And other companies, this goes back along that. Is there any concerns about them trying to grow too fast, too big, too fast? I guess is what I'm trying to say, and especially given the market environment that they're in today.
Yes, I think, and also because some of their acquisitions are usually international, the first risk that comes to our mind is with SOX, there could be regulations. They need to keep up with all of them, and HLI, compared to their bulge bracket competitors, it's a smaller firm, but they have a lot of regulation to keep up with, and that would be the first risk we would consider. But in terms of revenue generation, I think because HLI is into mergers and acquisitions, we think they would have the expertise into their own mergers and acquisitions when they acquire different firms. So, but yeah, it's just about picking the right app.
When you look at the management team, are there any folks rolling off? Any concerns about turnover?
Actually, the management team has been consistently a part of Houlihan Lokey for more than 30 years. I think the newest member has been there 29 years. But a lot of them have been throughout the company for a very long time and know the company very well, to which that they can continue to help the company grow and expand at a natural rate.
You talked about, and this is the slide that's up, ESG and sustainability one. Could you? Oh,
Thank you.
All right, we initiate our coverage of HLI with a buy recommendation, target price of $115, a 21% upside, including dividends. This recommendation is supported by strong sales growth drivers, operational efficiency, and a low risk financial position. HLI is a play, an undervalued play on global financial markets. So Houlihan Lokey is the #1 investment bank in global M&A, restructuring, and fairness opinions on financial valuations. The majority of its revenues comes from its United States corporate finance segment. Now, we do believe the investment banking industry is poised for recovery. In 2022, we did see interest rates increase at rates that we haven't seen in years. This paired with a decrease in asset values drove a price divide between buyers and sellers in the market. This slowed deal flow heavily. In 2023, however, we do expect interest rates to level out and asset values to recover. This will narrow the price divide and narrow the bid offer spread, particularly, increasing deal flow for HLI and throwing back into the market the pent-up demand from the previous year. So the competitive position of HLI is supported by experience and expertise and expansion. They have long tenured managing directors with a lot of expertise under their belt, and they also are the deal volume leader in the mid-cap market. And in addition to this, they have a lot of expansion through strategic acquisitions in both industry and geographically. This widens the moat of HLI. Now we'll look at the drivers. CEO sentiment is improving. Companies are expecting to make more and spend more in the coming years. This will directly ignite the massive amounts of dry powder back into the market and increase the deal flow for HLI, as it has positioned itself well to move with this increase in demand. As HLI operates primarily in the private markets, this is the best and has been the best position for the company, as private markets have outperformed public steadily for years. Particularly private debt and equity are expected to also grow pretty heavily over the coming years, as companies are expected and are staying private for much longer than in the past. Companies with high leverage will begin to hurt from the increased interest rate environment, driving defaults over the coming year. This will feed directly into HLI's restructuring business, which is considered #1 by both volume and value. This offers the company a nice counter-cyclical business model. And so no matter how the environment, no matter how the economy is moving, a part of HLI will always be working. I'll hand it off to Gabe.
All right, so for valuation, we use a PE multiple and a discounted net income model and weight them evenly to determine our target price, suggesting a 21% return. For our PE multiple, we expect the PE to contract back to its industry and peer and historical average, and for the EPS to grow due to the drivers analysis that we conducted. From that, we took our 12-month target PE and EPS to determine our target price. As for a relative analysis, looking at its PE, HLI is more expensive than its peers. However, it is also less risky, as shown by its lower beta and less volatile EPS growth rate. In addition, looking at its earnings growth, we believe that HLI is more cheap, especially when looking at its PEG of 0.74, especially in comparison to the S&P 500. Now, for a discounted net income model, we believe that HLI is best valued based on earnings rather than free cash flow. And this is because we believe that factors like depreciation or CapEx are not as crucial to the valuation of this company. So we took our projected earnings, our discount rate, and our terminal value to determine the target price for this company. As for our sensitivity analysis, we tested the impact on our target price that each business segment had on that on the target price. So from that, we determined that our target price is most sensitive to changes in our corporate finance segment. In addition, we also did recession scenarios to test our target price during a severe downturn situation. So even though while the target prices of these scenarios are low, we believe that due to a strong job market, a healthy banking industry, and low bankruptcy rates, that these scenarios are extremely unlikely to occur. As for HLI's dividend, while its dividend yield is lower than its peers, its dividend payout ratio is half that of its peers' average. And when you take its high EPS growth into account, we believe that HLI will continue to deliver a stable dividend that will grow substantially into the future. And lastly, we believe that HLI is a potential acquisition target for foreign banks. And we believe this to be the case because HLI conducts a lot of deal flow in which banks love to back those deals. And just when banks love to back those deals using their large balance sheets, which creates a strong synergy as a result. This can be seen, for example, with TD's acquisition of Cohen and SMFG's desire to increase its stake in Jefferies. In addition, when taking the high average offer price premium into account, we believe that if HLI were to be acquired by a foreign bank, investors can expect to see upside returns as a result. Now, Jose will handle our financial.
In our financial analysis, we expect Q1 and half of Q2 of 2023 to remain slow due to in 2021 and 2022, we expect the market to increase interest rates. However, from the second half of Q2, we do project a recovery back to 2021 and early 2022 levels. Revenue growth is expected to vary by segment, with corporate finance lagging and financial restructuring and valuation showing stronger growth as companies seek assistance in adjusting to higher interest rates. HLI believes that developing human capital leads to the success in their industry, and over the past 7 years, they have increased their managing director headcount by 75%. This growth through acquisition and recruitment has helped increase their revenue output per managing director by 89%. Over the same period of time, their compensation ratio has decreased by 500 basis points. Moreover, their fixed expense has been spread over a wider revenue base, resulting in widening margins. In total, HLI's net profit margin has increased to 90% in 2021, outperforming major industry competitors. HLI's low leverage, strong profitability, and healthy cash flows drive strong cash generation. And with this, these factors help reduce investor risk and increase financial flexibility, allowing them to take advantage of market opportunities such as strategic acquisitions. Our estimated AA long-term debt rating and low beta further confirms HLI's strong financial position. HLI's decreasing CapEx and increasing non-cash compensation drive strong cash generation. And with this, the free cash flow to revenue margin has increased to 32%, a full 30% higher than its net profit margin. HLI focuses on reinvesting capital back into the company through internal and external growth initiatives, positioning it well for future growth. We believe that the company is committed to returning capital back to investors, as almost 60% is returned through dividends and share purchases. And with this, investors can expect healthy and safe returns in the future for ESG. Eva?
Compared to peers, HLI has much room for improvement, but they are steadily improving. 45% of their listed energy transactions are with oil and gas companies. However, solar and electricity contribute to 30%, and they have no direct link to the carbon sector. Gender diversity could improve with only 3 of 11 board members being women, and all key executives are male. However, in 2020, they did launch an advisory group leveraging their skill to support women-led companies. They reported 22 billion in combined transaction value from 2019. They have a higher percentage of employee minorities versus peers, but slightly lag in executive minorities, and they support over 50 charities, including aid to Ukraine. CEOs predominantly paid in cash and less in share incentive compared to peers. And however, executives are mostly paid based on their performance. Investment risks. HLI is a controlled company with majority voting structure, voting interest held by the voting trust, leaving public shareholders powerless in corporate action and policy votes. However, their independent directors make up majority of 3 governance committees. They have substantially increased their foreign revenue exposure, and we tested the yen and the euro on their EPS, upside increasing 5% and downside falling 8%. They mitigate their risk through local hedging and reporting revenues in the same countries in which they incur expenses. Also, currently the dollar is weakening, providing a nice tailwind. Lastly, economic conditions have been impaired over the last year with economic uncertainty, slowing deal count. Also, regulators are ever more committed to impede M&A deals where monopoly and antitrust issues occur. However, smaller companies are less of a risk for monopoly issues, and a challenging market is an opportunity for financial restructuring business, which is countercyclical. In conclusion, we recommend the buyer recommendations. They're open for questions. Thank you.
Thank you. No, it's okay.
Forgot my cue.
No.
Alright, as soon as you ask the first question.
Okay, I just have, well, to start off, great job. I was intrigued by your thesis around an acquisition, that they could become an acquisition target. What kind of led you to that, and who do you think might be a potential acquirer?
Okay. So the reason why I believe that HLI is potentially an acquisition target for foreign banks specifically is because that many foreign banks are looking to expand their reach, especially into the investment banking industry, but they can't really like acquire a Morgan Stanley or any company at that scale. So many foreign banks, like for example, TD has acquired, they have agreed to acquire Cohen just this past year as a means of entering into this new market and expanding and diversifying their portfolio. And of course, investment banks like Cohen like to accept these deals because these large banks can back those deals that they conduct. So that's primarily the reason why the HLI is a potential acquisition target for foreign banks specifically. As for which companies, we believe, ideally we think large foreign banks maybe in Asia or potentially in Europe as well, but no bank in particular being in choose any.
So quickly, they have actually been acquired previously in 2005 or so by a Japan-based company.
You made a comment about increased deal flow going into 2023, stemming from what happened out of 2022. You talked about interest rates being flattened and whatnot, but what would be the biggest risk to that thesis? Because if something doesn't happen the way you expected, I'd imagine that's going to have an impact on what your valuation or your price targets.
Yeah, I guess the answer is in the question. It's always the market risk, right?
Yeah.
If what we don't expect to happen isn't going to happen, the interest rates will continue rising. There's going to be more volatility in the market. So of course, deal flow for HLI will continue to hinder. Of course, they do have the restructuring business, which kind of offers a nice counter-cyclical business model for them. So even if the market isn't going to turn around just quite yet, they still have that part of the business to support them. And again, on the compensation side as well, they're really doing a good job at managing that compensation ratios, which also helps pad and downturns as well.
Just a real quick follow-up on that. And so corporate restructuring obviously is currently a small percentage of their revenue. What makes you confident that that segment of the business is going to be able to hold up, or assuming that the deal flow starts to follow?
Yeah, so mainly their sort of their name, I guess, right? Their brand in the market. Of course, their revenue percentage is small, but just because of how strong they are in the industry in restructuring, it's kind of like the 800-pound gorilla of restructuring. Really, I don't think it's going to go anywhere in particular, just because of how good they are at doing that.
You did a nice job on the ESG slides, and I'm just wondering what your opinion is on, and it's not always important that the same person answer, but on the ESG, anyone can answer. Could you talk about what you think are the most financially material factors in all of these, and what did you consider important?
The most financially material would essentially be that they do not directly lend to the carbon-based sector, as many of these banks in this industry do that. So that sets them apart, especially financially.
So they do not? Is that?
They do not directly lend to the carbon-based sector. So they have no balance sheet, and they don't directly invest in any capital market assets in the carbon-based sector.
Okay, thank you.
I just want to spend a little bit of time on the valuation. Slide 14. So you got to talk about their earnings growth is cheap and stable. You have a PEG ratio there. But you're comparing it against the S&P 500, and I guess I'm just trying to understand a little bit as to why you're kind of, comparing it against, large caps when this is kind of a small cap, and was that the right way to go, or, were there other things you could have been doing to compare when you were looking at your evaluation?
Yeah, so as for the earnings growth for the PEG, the reason why we compared it more to the S&P 500 was more so just to show how the PEG is less than 1, saying that its earnings growth is cheaper relative. While we just choose S&P 500 primarily because the earnings growth in the industry overall has been fairly strong over past 5 years, which is what our PEG's growth rate is based on. So, we wanted to more emphasize how this industry's growth rate, especially relative to the PE, is really strong currently, and that it is also cheap as well. So,
on the previous page, I just had a question on the slide. The price of 100, and you have a different price target at the beginning. What can you just clarify that for me?
Yeah, so this $100 price is just for the PE multiple, and then of course the target price was 115, as you can see here. Yeah, we rated.
Okay. Yeah.
You talked about how they're able to contain costs on some of their valuations, but could you talk about how, since it is a people business, how that impacts their growth?
Yeah, so for the compensation costs, or we split their mixed costs up into two, so we have the variable and fixed. The variable would be the compensation and travel, so we have that flowing with revenue. So we have that as 80% variable to thing, and we noticed that 30% or 20% was fixed over historical figures. And we believe as the markets go up and down, they're able to adjust their compensation, so allowing them to mitigate, or not mitigate, but expand or contract their margins as they wish.
How does that affect them going forward, since people are important to a business like this?
Yes, going forward, we have historically their compensation ratio has been decreasing, so over 500 basis points. So going forward, we had it decreasing to 57% of revenue. That's for the compensation side. For the fixed costs, we had it fairly fixed over time, only decreasing around 200 basis points or 2% over the next 5 years. So that's going to widen margins quite substantially as revenues continue to grow.
So since we're on this page, and you may have already explained this, but can you talk a little bit about why you just chose those particular valuations versus, maybe, just did a discount or cash flow?
Yeah.
What were those two?
Yes, so we use specifically the PE multiple and the discount and the income because we wanted to focus primarily on HLI's earnings as a means of evaluating the company. And I stated this earlier in my presentation, but we believe that the reason I never chose a discounted cash flow over these ones was because we believe that factors like depreciation or CapEx are not as crucial to the valuation of this company specifically. So we believe that earnings are the best show as profitability, and therefore it's a good way to display that.
2 minutes.
Can you give me a little sense of how their revenue, in particular by region, has evolved, given that a number of their acquisitions in 2015 are all international-based companies?
Yeah, I don't have a particular figure in mind, but what we are seeing is most expansion within Europe, actually. They're doing a lot of both geographic specific expansion, so like our Central Europe or Spain, and also a lot of supportive services expansion in Europe as well. So I would say their US market is their largest, but as for their acquisitions, they are focused mainly on Europe, and then second to that is Asia, and those would be those 3 main markets that going forward will continue to grow. Generally what we're seeing.
Can you talk a little bit more about kind of the leadership of the company? And I was looking at your slide on 29, it was the incentive-based comp that it kind of lags the peers. And I'm just curious if there's, when you're looking at kind of their CEO comp and it's more cash, do you anticipate they may kind of switch around there at all, or what could be some risks here?
Sure. So currently they are a very liquid company. They have over 250 million cash, and their employees and previous and current own a little bit less or around 2% of the company. So that could potentially increase as maybe they use their cash for other purposes such as reinvestment or gaining more human capital.
Okay. Do you see any concerns with kind of leadership at this point? Anyone rolling off? Any turnover potentially, or?
Well, currently CEO sentiment is rising, so I don't see that happening anytime soon. All these.
Thank you.
Good job.
Good afternoon. My name is Katya and we're representing Chapman University. Joining me today is Omar, Kate, and Brad. With a premier suite of ESG products, expansive global reach, investment in human capital through acquisition, and ability to weather economic ups and downs through strong diversified segments, we're initiating a buy on Houlihan Lokey with a 109 12-month target price, reflecting a 12.5% upside from a $96 closing price. Established in 1972, Houlihan Lokey became a global industry leader in middle market investment banking. Today, this industry leader operates through three core segments: corporate finance, financial restructuring, and valuation advisory, as well as varied verticals including healthcare, energy, private sponsor, and many others. Within corporate finance, services include M&A as well as capital markets advisory. But it's in the financial restructuring segment where they've truly made their mark, advising on 12 out of the 15 largest corporate bankruptcies since 2008. Such as Lehman Brothers and Enron Corporation. In other words, they've demonstrated success when it comes to navigating turbulent financial waters, which is a likely possibility in the next 12 months. Houlihan is a premier leader in ESG-focused solutions, such as ESG M&A advisory, as well as helping clients utilize green finance, concentrating on sustainability-linked debt issuance. Clients choose Houlihan for their financial prowess as well as their ESG capabilities. Houlihan's focus is on retaining quality top talent streamlined through their global expansion strategy. With over 35 global offices, they continue to expand with 3 new office locations in Belgium, Baltimore, and Saudi Arabia. As they continue to expand in offices as well as industry exposure into EMEA, Houlihan reinforces its competitive edge in the marketplace. Houlihan's acquisitive nature continues into 2023 with over 9 acquisitions since their 2015 IPO. With this in mind, I want to touch on the 2021 GCA acquisition. With this acquisition, they established dominance in the US as well as EMEA. They acquired 72 managing directors, designated 35 ESG professionals, and established dominance in the market. On to Omar.
Thanks, Katya. As you've heard, Houlihan is a leading middle market investment bank. We define this by transaction size ranging between $50 and $500 million. This $19.2 billion market is dominated by 5 firms who together represent about 67% of the market. Houlihan alone represents 12% of this market, growing at a CAGR of 21.09% versus an industry average of 15.66%. Houlihan is a leader in transactions, with the most transactions under $1 billion, beating Goldman Sachs and JP Morgan. Whilst competitors typically compete within one of the broad segments of corporate finance, financial restructuring, or FP&A, Houlihan is the only firm diversified across all 3 of these segments in their competitor group. This diversification shields Houlihan from changing macroeconomic conditions. As M&A activity is impeded with rising interest rates, Houlihan's financial restructuring will emerge as a leader to distressed companies who are looking for solvency lifelines or creditors who are looking to preserve their capital. Houlihan's number 1 position is driven by 4 key drivers. It's expert and diverse human capital. It's growing global expansion. It's leadership and ESG advisory. And finally, its strategic product mix, which is built to weather economic headwinds. I'll now pass you over to Kate.
Now, let's spearhead ESG. Through cutting-edge environmental practices, comprehensive social commitment, and an experienced leadership team, Houlihan dominates their competitive market in the ESG field. As a service company, environmental conservation relates to the global physical offices that Houlihan leases. These offices employ revolutionary sustainable policies such as cool roof technology and rainwater harvesting. Through their acquisition of GCA Corp, Houlihan acquired the unique technical service of connecting IT asset managers with IT refurbishers. This drastically reduces the amount of harmful carbon released into the atmosphere from lazy end-of-life technology disposal. Looking through a social lens, Houlihan recently far surpassed a management goal to increase funding to female-led ventures, a historically underrepresented demographic in the M&A field. Houlihan takes an active effort in charitable donations and prioritizes internal diversity through their groups of robust employee communities. Pivoting to executive management, Houlihan's top officers bring dynamic leadership to the firm, with an impressive average tenure of 33 years. Houlihan operates as a controlled share structure with Class A shares held publicly and Class B shares held by insiders. B shares possess a 10-to-1 voting ratio to A, giving insiders economic control of the company. While some may regard this as a negative to shareholders, we view it as a net positive, given management's successful track record in making swift strategic decisions. Houlihan's 11 board members bring cognitive diversity to the firm, with skills ranging from AI expertise to SPACs, just to name a few. Where some may say executive management lacks gender diversity, 27% of the board is female, and key leadership acquisitions, such as Todd Carter of GCA, are seamlessly integrated into management. Now let's get technical with financials. For the past 5 years, total revenue has grown at an impressive 21% CAGR, driven by a complementary market environment and strategic acquisitions. Because Houlihan relies on strong human capital to drive revenue results, 85% of operating expenses consist of wages and salaries. Within revenue segments, financial restructuring is the most lucrative segment on a per transaction basis. Now, looking to the future, we forecast revenue to grow at a moderate 11% CAGR, driven by our assumption that financial restructuring will increase to bolster an otherwise sluggish corporate finance segment. Free cash flow will plummet in 2023 before slowly recovering as acquisitions materialize in financial statements. We forecast a consistent dividend payout ratio of 33%, which allows Houlihan to fund their acquisitions through both retained earnings and Class B shares. Lastly, looking at their capital structure, Houlihan is almost entirely equity financed, maintaining low leverage levels in line with low capital requirements. Should GAAP capital be required, Houlihan retains a substantial credit facility at Bank of America at rates of SOFR plus an applicable credit spread. Here's Brian for our evaluation.
Thanks, Kate. Our conservative target price of $109 was determined by allocating 50% weight to the relative valuation, 20% to the discounted cash flow and market value added, and 5% to the residual income and the dividend discount model. The 50% weight for the relative valuation is to take into account the overall sentiment of the market given the negative momentum. The discounted cash flow and the market value added were emphasized due to Houlihan's long-term expansionary strategy and its impact on free cash flow and economic value added. On the other hand, the residual income model is a little bit less reliable due to the fact that Houlihan tends to finance these acquisitions through equity, therefore making the forecast of book value per share a little bit less reliable. Lastly, due to Houlihan's expansionary strategy taking priority over returning capital to shareholders, the firm's payout ratio and dividend increases have meaningfully declined. This results in the firm stock being more attractive to investors as a growth stock than a dividend stock. Kicking it off with our DCF, we assumed a 7.73% weighted average cost of capital, driven by a 7.8% cost of equity and a 0.2% weighted average after-tax cost of debt. This optimal valuation resulted in $137.29 12-month target price. The market value added is most relevant to Houlihan as it reflects if the firm's expansionary activity has had a positive economic value add. As you can see, the ROIC is approximately 23% for 2023 and set to decline to a steady rate of approximately 15%. The final target price is $106.09.
2 minutes.
For the dividend discount model, due to the reduced payout ratio previously spoken about, the final target price is $45.77. Turning our attention to the residual income model, we expect ROE to decline due to the equity financing, but to still exceed the required rate of return, resulting in a positive residual income. The final target price is $91.29. A Monte Carlo analysis was utilized to test the intrinsic value target price sensitivity to key financial metrics. Given that these are the main factors of intrinsic valuations, and with 10,001 iterations, the Monte Carlo analysis suggests that our target price falls at a confidence interval of 90% or higher.
1 minute.
Finally, the relative valuation was based on forward-looking multiples, and Houlihan was compared to its competitive peers. the average relative valuation target price is $107.40. Ultimately, our valuation provided a conservative target price of $109. Thank you. Here's Katya for the risks.
Thank you, Brian. We chose to assess both market and firm risks associated with our buy recommendation. Although there are multiple risks, a major risk is if Houlihan isn't able to materialize these acquisitions going forward, which would produce not as robust revenue growth as anticipated. Market risk does pose a big threat as bearish sentiment continues into 2020. As a premier leader in ESG-focused decisions, and expansive global reach, and continuous focus on human capital excellence through strong diversified segments, we are recommending a buy recommendation on Houlihan Lokey with 109 target price. Thank you.
Okay.
Right. So I'm gonna have to digest for a little bit.
That's
Go
okay.
right ahead.
Well,
Go ahead, whenever.
Great job. It's a lot to get in such a short time. One question, if you can elaborate a little bit on your valuation relative to your Monte Carlo analysis. At a 90% confidence interval, seems relatively low relative to the bell curve. Is there a reason you're being conservative? You might argue that your price target's maybe a little low based off of the valuation metrics.
Yeah, that's a great question. If we want to pull up the Monte Carlo in the appendix, thank you. Yeah, so 90% we are confident that our target price will be for the intrinsic value target price. And as you can see here, 75% of our outcomes returned a 25% or higher for the Monte Carlo analysis. So we're confident at 75% that the target price will be higher than 25% of the current share price. And that this sensitivity analysis was based on the dynamic sensitivity of revenue, NOPAT, free cash flow, capital, and dividends and earnings. So we are being conservative, yes, but we are very happy with the Monte Carlo analysis that we.
Building off of that, we do recognize that pitching a buy in a slightly recessionary environment may be a struggle for some of you to wrap your heads around. So we wanted to make sure that we were using an ultra conservative confidence level.
Can we go back to, you were talking about kind of the voting trust, and you were very optimistic about that as far as, you know, really how it can influence decisions with the business or with the company. And I'm kind of curious about the other side of it. What could be a negative side to that, as far as not having a lot of public say in it? You know, could there be lack of controls or something along those lines? I'm just curious from your take as you were analyzing that.
Yeah, from an investor perspective, I think it can be a little jarring because we're used to, when we purchase equity in a company, to having rights as a shareholder. So recognizing that you have almost all the powers except for that customary voting may be hard for shareholders to wrap their head around. However, with analysis, we do believe that their management's strong, successful track record of not having to work around shareholder voting, they can drive results a little faster.
Just adding to that, I think tenure of the board, it gives the shareholders quite a lot of confidence because there's quite a lot of history there to measure against as what they've done previously.
Okay. Yeah. Following up, similar to Hina's question, I have a two-part question on ESG. One, you said that they have premium ESG offering. Is it a little bit hypocritical of them then to not have the best ESG? And some of the biggest factors are like governance that Tina alluded to, and also not having diversity. You mentioned 27%, the standard is 30% for board directors, and they have none on management. So that's part one. And part two, what are the financially material ESG factors for the industry, and how did you factor this into your analysis?
All right, starting with the first one, can we please go to appendix 2.9 of environmental highlights? So one thing with ESG, we love how they're prioritizing both internal and external ESG. So because they're a service provider, that physical ESG may not be as relevant. However, for their clients, they actually offer environmental consulting and offerings on that regard. And then for S&G, we like to prioritize cognitive diversity of boards. So whereas external characteristics definitely drive different perspectives, we think that it's awesome that the board has experience in electronics manufacturing and AI and biotech, and that brings that different diversity to that brain trust.
And kind of going off that for their internal ESG offerings. So they do offer ESG advisory, and that's on social governance and environmental. And although they are working towards becoming more ESG on an external front, it does put them in a competitive advantage to continue offering these services, as financial firms are kind of slow to adapt to the importance of ESG and long-lasting impacts in the world.
So following up on some of your responses, so do you think that if there's cognitive diversity, there need not be any other kind of diversity?
That's a great point to make. We think that they have a lot of room to grow within maintaining a more females and diversity on the board. However, that's going to come with time. And can we go back to the appendix, please? To 2.7 as well. Here we have the average number of females on boards by market sectors. So they are leading the financials industry with their 27%. However, there's always room to grow, prioritizing cognitive and gender and ethnic diversity.
In terms of the revenue segments, you made mention that they're leaders in a number of them. Is there one in particular where you think they have, a specific competitive advantage relative to their peers?
Well, Houlihan is uniquely diversified across all three sectors. So some of the peers also provide capital, so they're more risky in terms of their makeup. So Houlihan is a pure advisory firm, and the advisory side is the FP&A is completely separate, where some wrap that up in corporate finance. So that's what makes Houlihan unique. They're diversified across all three segments.
And going off of that, a majority of their revenue is comprised of corporate finance and financial restructuring. So their acquisition strategy is geared towards corporate finance expansion, whereas their financial restructuring is what they're known for. So if we do see a downturn in the environment, in the macroeconomic environment, they're poised to capitalize on that financial restructuring growth. And if we see the opposite happen, where it's not as much of a recession, or if we see an upturn, that corporate finance acquisitions, as they continue to materialize, so they're kind of hedging both ways.
And to build off that even more, Houlihan Lokey has a competitive advantage against the big bulge bracket banks, is they have a conflict of interest because they issue debt, which Houlihan obviously does not. So that's unique in that sense there.
Can we talk a little bit about kind of the human capital side? Because, I think their compensation ended up declining quite a bit at the end of their last fiscal year. I'm assuming, it had to do with lower deals, that sort of thing. But would you anticipate them potentially having to, reduce, expand? Like how is their human capital going to be impacted if we go into some of these different, these market scenarios you're talking about?
So this relates to compensation. So I think that their compensation structure is quite complementary because it relies heavily on incentive-based compensation, which drives managing directors to be more profitable because not only do they benefit more, but the company does as well. And then their incentives are mainly based on 3-year average of revenue. So it does take into account some of those larger years that we've seen in the past. However, I think that because Houlihan makes very strategic acquisitions that are driven by the human capital that they will acquire, that should be not too much of a risk in the future.
Houlihan also funds some of their acquisitions through the buybacks on the Class B shares. So it is quite beneficial that Houlihan has that human capital there, because they're still actually hiring at the moment in M&A. So they're anticipating and preparing for the future uptick. And also with the acquisition of GCA, they've just expanded as one of the fastest growing banks in Europe. So there's lots of opportunities there within the human capital to benefit from future expansions there with those Class B shares.
And to supplement off Omar, this graph is just showing how many, based on LinkedIn data, how many external hirings they're currently doing in comparison to their peers and the size of the company. So just showing this as evidence. Yeah.
Could you talk about what are the risks that you see to your analysis?
Yeah. So as we mentioned, there are market risks as well as firm risks. Some firm risks are if they're not with a global expansion strategy as well as focusing on acquisitions. If those acquisitions aren't able to materialize, there is risk in that. As well, we do want to touch on overpaying on acquisitions in regards to goodwill. So although their goodwill is evident, which, in a market environment where you're making strategic acquisitions, of course, you're going to have to pay more. It's a competitive market. However, if we look at the impairment on goodwill, it's very minimal and only 2%. So as they choose to pay a premium now, they're getting that long-lasting competitive advantage to be the global dominant player in mid-market ESG focused financial decisions.
Continuing on the line of acquisitions, I'll go fast just 'cause I know we're running out of time. Given the amount that they've done so fast in such a short amount of time, any concerns with integration? Do you have any evidence to show that they've been able to integrate these firms into HLI seamlessly or no?
Yeah, I mean, historically, as you can see, the share price has really risen. They've got the history of acquisitions there, and they've worked out very well. They've all been accretive. We haven't spotted any in our analysis that haven't been accretive. So no reason to think that won't continue.
Touching once more, we do think that the amount of impairment is very important because while goodwill does sit on the balance sheet, only that impairment is what is actually written off as an overpayment, which remains less than 2%.
You talked about SPACs and sustainability linked debt in the beginning. Both of those have come under some criticism. So could you talk about that, how that factored into your analysis?
On the note of the SPAC for the board of director expertise, it was.
We'll get back to that. From Cal State University of Long Beach, we have the Beach Investment Group. My name is Kai. This is Isaiah, Luke, Kenny, and Nicholas. Today we will be presenting about Houlihan Lokey. We issued a hold recommendation for Houlihan with our price target of $99.28. And here's a quick snapshot of just the company overviews. First, we begin with our business overview, heading into financials, ESG, the investment risk valuation, last but not least, our Q&A and conclusion section. Starting off with our business overview, Houlihan Lokey does operate in 3 segments: corporate finance, financial valuation advisory, and their financial restructuring. With financial restructuring, they do operations in distressed debt, financial valuations, modeling, and just giving companies their fair valuation, and corporate finance working with M&As or mergers and acquisitions. As you can see here on the chart, they do operate 64% within corporate finance. That is their biggest segment in terms of generating revenues. Here we can see our segment trends. Corporate finance has been increasing for them over the last couple of years and heading on towards. Now I pass it on to Kenny to do financials.
Thank you. Now on to see with activity in the M&A space, we see that deal activity in M&A has taken a huge cool off since 2021 with the Fed hiking interest rates in order to combat inflation. We see that with deal volume, it has decreased about 20% since 2021, yet deal value has taken a deeper cut at around just under 60% for that same period. To note, for 2022, we also observed elevated levels of volume with depressed levels of value within that same time frame. Next on we see with profitability and returns, Houlihan Lokey in terms of a return on equity and invested capital, they do lag behind competitors, as much of that said capital being directed towards expansion and growth of the company. On the flip side, however, profit and operating margins do lead at 14% and 18% respectively compared to competitors, signifying a strong, healthy bottom line and healthy operations on the company's part. Now onto the capital structure, we see that Houlihan Lokey has consistently held a debt to asset ratio lower than their competitor median for over 5 years. We see in 2022 for that space, Houlihan Lokey has managed a debt to asset ratio of around 10.5% to competitor median of 18%. However, we do see that an increase in accrued salaries, while cash has stayed flat from the period of 2021, has lowered their current and quick ratios, sacrificing short-term liquidity for expansion in the mid to long term. And now on to Nick with the ESG section.
Thank you, Kenny. So Houlihan Lokey has taken some measures towards ESG. Environmentally, they've been trying to lower the carbon footprint and energy consumption by having some of the locations run off renewable energy. Socially, they provide their employees with different programs that provide support and bring awareness to certain social issues. When it comes to governance, they have a rewarding pay structure for their executives based on performance that pushes them to perform more year after year. Despite their efforts towards ESG, Houlihan Lokey has some moderate scores compared to the peers. When analyzing 14 different policies that are deemed important for sustainable operations, such as energy efficiency, green building, waste reduction, and water policies, Houlihan Lokey only engages in 5 giving them a score of 36%, ranking them 5th amongst their peers. When analyzing 20 different social policies and initiatives, such as anti-bribery, human rights, health and safety, and consumer data protection policies, Houlihan Lokey only engages in 8, giving them a score of 40%, ranking them 6th amongst their peers. In terms of governance, there's not much diversity when it comes to the board of directors. Only 27% of Houlihan Lokey's board of directors is made up of women, which ranks them 6th amongst their peers. So they're kind of lagging in that sense. And another important thing to note is that one of Houlihan Lokey's executives, Scott Adelson, got caught in a scandal and accused of leaking out information about a business and therefore was being sued for this. And now I'd like to pass on to Isaiah with investment risks.
Thank you, Nick. So Houlihan Lokey's two main sources of revenue come from their corporate finance and their financial restructuring segments. Both these sources of revenue, the fees are collected upon goal completion due to the nature of Houlihan Lokey's business. So this affects the revenue this affects annual and quarterly revenues. Since 2017, Houlihan Lokey has had a steady increase of international growth. In 2022, Houlihan Lokey has had a 26% of international growth, and they continue to plan to expand to non-US based regions. With a higher exposure to international growth, international operations comes a higher potential for risk for political and environmental. Since March of 2022, the Fed has been combating inflation by hiking interest rates. With high interest rates, this affects mergers and acquisition deals, and it creates uncertain economic times. This also plays into a factor of geopolitical variables. Next, I'll pass on to Luke, who will cover valuations.
Thank you, Isaiah. So in our analysis at Houlihan Lokey, we utilized 4 different valuation methods, but today I just want to walk you through 2 of those. The first and most important valuation method that we utilized was the discounted cash flow model. So as you can see here on the screen in our revenue estimations, during calendar year 2022, Houlihan Lokey produced $1,835 million in revenue, which is a 20% decrease from the previous year. This is a result of that drop in M&A that we already spoke about earlier. In 2023, with our first actual revenue estimation, we have the largest individual increase at 11% projected for that year. To provide some rationale for this, we can look back on how interest rates have affected the environment. Over 2022, we saw central banks hiking rates, and as a result, there's a slowdown in mid-cap transactions, which is the area that Houlihan Lokey primarily operates underneath. As a result of this, there's lots of pent-up M&A demand in the environment right now. So we believe that once there is more broad-based confidence in the economy, which is a trend that we've started to see over the past several months, Houlihan Lokey can capitalize on this pent-up demand and make strong gains in 2023. After 2024, we have them growing at a flat rate of 7%, which brings our overall compounded annual growth rate for the 5-year period to 8%, which is above the projected industry average at 6.5%. Aside from revenues, in calculating our weighted average cost of capital, we utilize components like a 5-year weekly historical beta of 0.612, tax rate of 27%, which is in line with our long-term expectations for taxes. And inputting several other inputs, we derive a weighted average cost of capital of 7.7%. For our long-term growth rate, we utilize a rate of 3%, which is calculated taking the United States historical real GDP over the period of 1960 to 2022. With all these different inputs, we derive an intrinsic value of $99, giving Houlihan a 2.5% upside from yesterday's closing price. For our second valuation method, we utilize a dividend discount model, and this involved simpler inputs than our DCF. As you can see here on the screen, over the past several years, Houlihan Lokey's dividend payout ratio has remained relatively consistent, fluctuating within around a 15% band. We then took the average of this dividend payout ratio, which came out to approximately 36%. Our next step was then to estimate net income for the 5-year period to 2027 and multiplied it in a similar fashion to our revenue estimations for our DCF. We then multiplied our average dividend payout ratio with these net income estimates to estimate yearly dividends. Using the same cost of equity and long-term growth rate for our DCF, we derived an intrinsic value of $63, giving them a 35% downside in this valuation model. To conclude what we talked about today in our presentation, I want to summarize some key takeaways. First, some of the advantages that Houlihan Lokey possesses would be stronger financial performance against their peers, as well as their financial restructuring segment that can act as a hedge against economic downturn that their competitors lack except for Jeffries. On the other side of things, some of the negatives for the company would consist of their weak ESG ratings, as well as marginal upside from valuation models that we talked about today. Overall, we have a lack of strong conviction from either a buy or a sell perspective, and due to the belief that Houlihan Lokey seems to be trading near fair price, we would recommend that you hold their stock. With that, I conclude our presentation and will now be able to answer any questions you may have. Thank you.
So can we talk a little bit more about kind of the overall management structure? You had mentioned 40% of the, I think it was 40% of the board was were women.
Only 27%.
27%. Okay, I got the wrong number. Okay. So just kind of thinking about, you've got the lawsuit against Adelson. What are some of the risks you currently have with the current management structure, the fact that you've got, a lot of ownership within, a specific group? What are some of the risks that, you kind of see with the overall management structure?
I guess one risk based off what's going on with Allison is that mostly trust and like what is actually going on with their executives, because he leaked information about not directly associated with Houlihan Lokey, but with a different company because he's on that board of directors. And just from that sense, it's just the ethics behind it. What ethics are they really providing, and what are they working towards? So that's just a risk that management. Can you trust the management or not?
Yeah, I mean, is it headline risk that you're seeing, or do you think it's? I mean, does everybody know this?
No, everyone knows this. It was. I had to dig deep to find about this because this was in 2021, and I don't know the outcome of it. I don't know if they did I just don't know the outcome, so it's just something I brought up.
And then to add on to Houlihan, he does have significantly less in terms of like voting rights. So even if he were to be out of, with their company in terms of like if it was bad reputation for them, his voting terms is like I think like 2 to 3%. So it's not as significant to the company itself.
Okay.
You make a comment on one of the slides that international exposure could cause potential higher political or environmental risk. Can you dig into that a little bit deeper? Because my question would be, given their acquisitions of international companies, it seems to me that they might have that at least kind of figured out, or they might argue against that point, I should say.
Yeah, so for short term, or it's more like short term risk. So when Houlihan does acquire a new company in the short term, there's certain rules that Houlihan has to adhere to. And if they don't really follow those kind of regulations, then it could kind of affect their company as a whole. But in the long term, when it comes to acquiring new companies, like especially internationally, we feel that it has it's a big plus for the company as a whole.
I would like to also add on to that. I think what he said is definitely correct in how it's a short-term risk versus long-term potential advantage. And just to provide a little context, as we weren't able to get to their acquisitions in the presentation, recently they've shown that they're acquiring more than some of their competitors. A big acquisition they had recently, about a year and a half ago, was GCA Corporation, which was around a $500 million acquisition. So definitely on the larger side of some of the acquisitions they've made. And that company has exposure to Asian markets that they don't necessarily have a strong presence in. So near term, it's kind of a risk because it's an unknown, acquiring a new company that primarily operates in a region outside where they're comfortable with. But long term, we definitely see it as an advantage because Asia had at least compared to Europe and North America, where that's their main operations, Asia saw the lowest drop in M&A activity between those three regions. So like 20% or 25% versus around 50% M&A decline in both Europe as well as North America. So yeah.
Good job on the presentation. So looking at your models, you have 5 models and you explained 2 of them. 4 of the models, if I'm reading it correctly, show up, price that's lower than the current price. So why did you select hold or fair price as one of your slides say, rather than a sell?
So just to clarify, the four models that we used, two of them showed downside, and the DCF shows slight upside, and then the Monte Carlo simulation shows higher upside due to its more historical nature. So definitely, we think that in creating our valuation, first of all, the dividend discount model is a more conservative approach anyways, so you're expecting it to be on the safer side of things. So that's an explanation for, even though it provides that 35% downside, that pairing with other models, you might not necessarily just rely on that 35% downside. The relative valuation came out to an average around $82, which is definitely less of a drop. And it mainly has to do with the fact that they're trading at a slight premium versus most of their peers. And then our DCF model, we think, is it involves the most different factors. So that's why we would say that we maybe look to that one as one of the most important, although it's definitely, you don't just want to look at it by itself. But overall, we think that, yeah, with the fact that the dividend discount model is a little bit more conservative, and also our long-term growth rate is definitely on the more conservative side, using the historical real GDP, getting that relatively lower rate, whereas we could definitely see them potentially outperforming that long-term growth rate, which would significantly alter some of these valuations. But in creating these models, they were meant to be conservative just due to the current economic environment.
And then to add on, their other two segments are actually increasing in terms of revenue. So corporate finance went from 70% to 64% as of 2022. So having that diversification makes them a stronger reasoning of why you wouldn't want to sell the stock and have it a hold and to see where economic variables would turn out.
Just to clarify what she said, the percentages increased for financial restructuring valuation as a total. However, restructuring was the only one year over year from the most recent earnings report in January that was actually up year over year. Their corporate finance saw the biggest drop, and then valuation also dropped, but not as significantly.
So the valuation, you start out the presentation where you have the hold with a price target of 99.28. So when you could look at the valuation, I'm just making sure that I'm following it. You just use the discounted cash flow. So it's just 100% of the valuation weighting is on the DCF.
Not necessarily.
Okay.
So that was kind of an issue that we came across in making it, is we didn't necessarily want to weight the models based on importance. So we just decided in the start to use that DCF model as kind of our like overall price target, and then the other valuation methods complement it to give more context. Yeah.
Okay, but the recommendation is based on the 99.28 price target.
It is. Another thing to expand on just the overall kind of recommendation of what led us to getting that hold recognition. Valuation wise, like we said, there tends to be more marginal upside, and part of that is the conservative nature. But on the other hand, as far as like the qualitative side of business, they seem to have lots of advantages over their competitors. They have a faster growing MD headcount over the past basically 10, 15 years than their competitors. They're also much more internationally expanded, which, like we said earlier, is a short-term risk, but long-term, that's kind of a catalyst for their growth. So some of the 5 companies that we use, for the most part, except for ESG, we added some extra companies, but we use Lazard, Jefferies, Evercore, JPT, and Moelis. And so basically all these companies, first of all, Jefferies is the only one that has a somewhat significant financial restructuring segment. And if you took the average of their international exposure, most of these companies, the average comes out at 20% versus HLI's 30%. So they have that kind of these growth catalysts that long-term, we think they are a better company. But part of the reason for the whole recommendation is just due to the fact that they're already trading a little bit of a premium. So we have these qualitative factors that are strong for the company. And then with the safe valuations, it doesn't necessarily provide a lot of downside, but definitely doesn't provide significant upside.
Okay.
Is there a revenue segment that you think that they have a stronger competitive advantage in relative to their peers? I know corporate finance was the biggest segment by revenue last year, but if you look back historically, it doesn't look like it was that much of an outlier.
So if you look at which segment's the most important, their corporate finance is definitely the key driver of the company. We think though, as far as like something that sets them apart, the restructuring segment definitely sets them apart. Also, because of the relational nature of the business, having that financial restructuring segment in a time like this And they also have a really good reputation in the restructuring. The 12 largest or the 15 largest bankruptcies since 2000, HLI was involved in 12 of those. So they have a really strong reputation in that sphere. And then on the corporate finance side of things, they actually do have a pretty notorious reputation for getting a large number of deals, not necessarily volume, but because they're in that middle market below $1 billion transactions, they actually led all investment banks in transactions in both M&A and restructuring. So they had 357 M&A deals, which is the most, like the highest number of deals, and then 58 for financial restructuring.
And since they're a services company and they charge fees and stuff like that, it just seems like M&A is a growing kind of field, and that's why they're going to Houlihan Lokey tap those fair valuations and then the other services.
Good job, guys.
Yeah.
Thank you.
Well, hello, everyone. My name is Diana Smith Gonzalez from CSU San Bernardino.
My name is Robert Troggett from CSU San Bernardino. We had 3 other members here, but due to probably like one of those weather balloon alien invasions, something like that, you know, they got abducted. So, you know, we're gonna get right into it.
So let's go ahead and do the brief overview. The company has 3 business segments with our corporate finance, financial restructuring, and financial and valuation advisory. They provide services such as the mergers and acquisition, the M&A, and capital markets.
And looking at the economic moat, we can see that it has again those 3 business segments of corporate finance having that 30% growth, financial restructuring seeing about a 5% growth, and financial and valuation advisory seeing about a 17% growth. And we see that those pre-tax margins have been increasing due to operating leverage since it's been going public, and these factors have allowed HLI to sustain higher returns than its competitors.
Let's look at the favorable margin. So HLI's track record of double-digit adjusted pre-tax has grown since 2017 to 2022 due to the economic downturn. Also, most of their business expenses are related to the employee compensation.
And if we look at the business description here, it was founded in 1972 here in Los Angeles. They got offices all around United States, Europe, Middle East, Asia Pacific. And again, they got those 3 business segments with 33 locations worldwide, about 2,200 employees, and 850 of them are shareholders. And the tenure of the management team is about 33 years. So they got a pretty tenured management team.
Okay, let's look at the history and management team. Houlihan Lokey was founded in 1972 again by Richard Houlihan and Houlihan Lokey. Originally, they started as general business advisories to private companies, and in 2015 of August, they were on the New York Stock Exchange. The average retention on the managing director is 12% across all business sectors, and over 66% of managing directors have held their position due to internal promotion.
And if we look at their customer base, we see that they advise 10 of the 12 largest bankruptcies from 2021. They're listed below here. And we see, it's a wide variety of industries from healthcare to food and retail, and also majority 72% is based in the United States.
So let's look at the environmental, social, and governance. 23 offices are built all over the UK with LEED certification. 100% renewable energy is being used in the UK. They promote EV and public transit. Again, let's look at their social focus. They promote diversity, equity, and inclusion. Not only do they promote diversity and ethics and gender, but they also promote diversity in thought by collaborating with groups of people. And as you can see here, they take pride in communities, cultivating these communities. They support women businesses. And not only that, they supported over $3 million to relief efforts in Ukraine. Here are the 3 pillars that they stand for: recruiting and pipeline development, engaging in community, culture and community, and policy and program development. They like to advance in existing programs.
Looking at governments here, we see that as of March 31st, 2022, the voting trust controlled about 78.9% of the capital stock's voting power, around 27.3% of the economic interest. This allowed the management team to resolve conflicts of interest to its electing its directors and approving updates to its governing documents and potential corporate transactions. Looking at its board of directors, we can see that even though they're preaching diversity in ESG, in their ESG statement, we said the board of directors is not as diverse. It's 80% white, 20% African American, 30% female, and 70% male here. Looking at executive compensation, we can see that the CEO is very lowly compensated and does not take stock options in the compensation package. So the stock price does not really affect the CEO's income hardly at all. And then looking at the shareholder structure.
The shareholder structure, the majority of the shareholders are owned by Vanguard at 9%, Ernest Partners at 7%, BlackRock Fund Advisory at 6%. The executive team and the board of directors own a very small percentage of the share in the company. Let's look at the industry overview. Many revenue drivers such as underwriting and corporate advisory services are in higher demand. Therefore, investment banks and brokerage firms are eager to submerge their services into a broader array of industries and sectors in the economy.
And then we're gonna look at some of the key external drivers here. Really want to point out corporate profit. And we can see that uncertainty creates an unfavorable market for IPOs and M&A. However, it increases trading activity, and increasing trading activity is going to lead to higher trading volumes. Asset fluctuation, investor uncertainty, it's going to increase with this. If investor uncertainty would decrease, resulting would decrease trading volumes, etc. And going back down to the bottom here, you see that uncertainty in the market. Investors are making moves consistently when the market's moving up and down, which is going to cause institutional investors to try and basically beat the market returns. And then right here, so if we're taking a look at inflation here, we can see that it's been on the decline because the Fed raising interest rates. But what we can see is that just recently, we just got the latest inflation report of only 6.4, so it's about a 0.1% decrease here, which means that the Fed is likely to keep increasing rates. And if we're looking at the interest rate calendar here, we can see that interest rates are roughly around 5% now, when the market consensus is only about probably another 2 rates of about 25 basis points. But due to the last number here of 6.4%, we can see that 25 basis points is probably off the table. That's due to the Fed's target being 2%. We're not going to get there at the current rate of raising the interest rates. So interest rates are likely going to rise higher.
Let's look at the competitive position. Again, HLI is the #1 investment bank in the MA. They're also the #1 global restructuring firm. They also, because of the diverse clients in various sectors of the economy, they've been growing since their IPO. Let's look at the comparables. So their competitor is Evercore, and they, but because HLI's high margin and strong reputation, they've been doing really great ever since the global financial crisis.
Yeah, one thing to point out is that so Evercore, like their advisory business, made up 70% of the revenue. And then LAZ performance has also been growing like with the market as well.
Let's look at the market dynamics. HLI's overseas business are still in their early stages, so there's a lot of less competition, a lot of opportunities in areas of Australia, Middle East, Africa, and South America. They've been growing since 2014.
Yeah.
Again, let's look at the geographic footprint. Their offices in Europe, Middle East, and Africa have accounted for 24% of their revenue and only 4% of Asia. What does this tell us? It tells us that the firm believes Asia offices will expand due to the acceleration in the emerging markets.
Yeah, and if we're looking at acquisition here, we can see it over the past 7 years, they acquired 12 companies. They're just going to be listed below right here. And then looking at revenue and profitability, we're going to break down 3 business segments. We see that corporate finance is about 70% of the business, financial restructuring about 17%, financial advisor around 13%. These business segments are going to be impacted by interest rates, GDP, managing director counts. We notice we notice a correlation between interest rates and revenues. We also notice a correlation between managing director counts and revenues as well. Looking at capital investment, we could see that HLI priorities are acquisitions, dividends, and share repurchasing. And shareholder compensation, we see that the share repurchasing program provided aggregate about $500 million to purchase A and B common stock. And they have a DE ratio of about 1, which is pretty desirable given that anything above 2.5 is a risky business. Looking at the valuation here, we're going to the discounted cash flow model. We're going to go over a couple of the assumptions here, which is a WACC, which we got at 11.88. This is some of the assumptions here is using the 10-year yield, and then also using a levered beta of 1.36. The way we got that, instead of using just HLI's betas, we took the beta of all of its competitors, got the average of all of its competitors, get a real beta of the market at the time. And with all these assumptions in place, we got an implied share value of about 125 per share using the discounted cash flow model. Going into how we got the free or the revenue growth rate is we got revenue growth, the median of all the competitors, and used that and got a median growth rate of about 12.63% year over year. Going into the dividend discount model, we have a base case of 20.7%, best case of 23.51%, and worst case of 19.53% using year over year dividend growth. And basically worst and best case, taking out the best or the worst year in dividend growth and calculating the average that way. And then using sensitivity analysis, we use the WACC and the growth rate as those are the two things that are really going to affect the stock price the most. And by using those and taking the best and worst case of each one of the scenarios and taking the median, we got our sensitivity stock price 185.26 per share. Now, one of our other scenarios here is we managing directors, they do point this out in their presentation or their investor presentation. The managing director headcount.
Good job.
Okay. We'll ask a bunch of questions.
All right, whenever you'd like to start.
Yeah, I think the obvious one is let's go back to your valuation. Because the last one you left off was the head count. So kind of help us understand, because I believe your original premise here is you got a target price of 128. So help us kind of understand how that was derived.
Yeah, so using the manager director headcount, they laid out in their investor presentation about how much money per year managing director makes on average, and then how many managing directors that they hire per year. By using this, we did take out this outlier of where they hired a bunch of managing directors here of 289, because right here they have about 11%. It went down to like 8.9%, something like that. But if we talk to the CFO on a conference call, CFO stated himself that they're not going to fire any managing director specifically. It's from his own mouth, so I'm just saying. But this
what actually led to that? What led to the big increase in managing directors?
They're expanding. So that's one of the big things that when they increase managing directors, it directly affects revenue because each managing director is usually capped at a certain amount of money. So like they hire a managing director, that managing director generates $7.8 million in revenue for the company. It's about the same for every managing director.
Yeah, but what did they go on a hiring spree? Like what was the Oh, okay.
Yeah, basically they just decided to hire a lot more, specifically because of them growing their I believe it was
The FA.
it was not the United States segment, but one of their global segment.
Okay, so it wasn't through an acquisition or anything, it was just
Yeah.
organically growing it.
Yeah.
Okay.
Yeah, because this is 2022. I think their last acquisition was in the end of 2021. Yeah, something like that.
Okay.
Could you elaborate a little bit on your projected macro market environment, over the I don't know, course of the next 6 to 12 months, and why that's going to either help them or potentially hurt them?
With interest rates?
Sure.
Okay, so if we look at interest rates, we couldn't get to it, but we can see that the company is not it's not as affected by interest rates, but it's on so right here. So HLI's business is not capital intensive and generally does not issue debt or invest in derivative instruments other than foreign currency or hedging purposes. As a result, it's not subject to significant market risk, including interest rate risk. So we can see that the rest of the market is really sensitive to interest rate risk, and HLI is actually one of those companies that those companies go to help them out, if that makes sense. So by them being impacted by interest rates and et cetera, it can give HLI extra business.
Okay, just quick follow-up. What component of their revenue source, be it corporate finance, restructuring, or M&A, the other one, do you think that's going to help the most?
If we're looking, I mean, probably financial restructuring. If interest rates are going, through the roof, companies are going to definitely want to restructure.
On your valuation, I see that you have the DCF. Could you talk a little bit about how, the sensitivity of the terminal value and how you factor that into your recommendation?
Yeah, so what we did is we took sensitivity analysis of using our best case scenario WACC and best case scenario growth rate as the bottom here, right here and right here, and then basically spreading it across and then getting a median here. So we basically just got a median of our WACC projections and our growth rate projections to get this stock price here. The way it was factored into the stock price at the very end was that we took all of our different projections and took an average of those. So let's say like we got 185 here, and on the DCF, we got like 125, 125 point something here. And then if we go down to, let's say the dividend, hold on. If we go down to, where's that right here? So dividends was at like 107. And then I actually, in the appendix, I wish I would have put the also the different stock prices for the different WACs as well, but they were all calculated into that final stock price, which was final stock price recommendation was around 128.33 per share.
So that's composing 3 different valuation metrics.
Yeah, that's gonna be that's gonna be composing of managing director revenue. So inputting that into the revenue forecast and DCF. And then that's going to be composing of the DCF itself, that's using the median average revenue growth rate of all the companies in the sector, and then also using the dividend discount model.
Okay. Can you speak a little bit on, the governance side where you talked about voting trust? Do you see that as a positive and negative? How did it kind of influence?
It kind of, you could look at it both ways. You could look at it kind of as a negative because they have such big control in there. It's probably also why you could see how their board of directors is also not diverse. There's probably a correlation there as well to them having majority power in what they decide what they do, and also not having a diverse board of directors. And, like there's a couple things there that are kind of building up on top of each other. I guess in terms of that, I would honestly say that is more of a bad thing, that they own so much control of that.
Yeah, I was kind of curious from an ESG perspective, kind of how do you grade them, from a B, C, D?
Yeah, probably like C.
Okay.
Yeah, probably like C area.
In terms of the strategic acquisitions, they've made quite a few in, I would say, a relatively short period of time. Do you see that as positive, negative? What are your thoughts there?
So if anything, if you build a company too fast, it's destined to fail, right? But I feel like they've been doing it they've been pretty strategic with the way that they're doing it. They're trying to increase their geographic footprint. They're not just acquiring United States-based companies, right? If you're just acquiring United States-based companies, then you're just in the United States market. If you're acquiring global companies, Asia market is different than the US market, which is different than the Middle Eastern market, which is different than Africa's market. By really factoring in all those different markets, they're all in different business cycles, they're all in different economic cycles. It actually is probably leveling out the company more than hurting it.
Could you talk a little bit about, you talked about restructuring a little bit. How are they using their free cash flows in the restructuring? Did you look at that and could you talk to that?
Free cash flows in the restructuring.
In that segment?
I don't have a slide on it. I remember briefly going over it. I'd say that using those cash flows in the restructuring is probably going to be more based on their managing directors and the geographic footprint.
How so?
If you're going to restructure the business, you're probably going to restructure it from the top down, and I'd probably say geographically and director wise, it's you guys are the top of the business right there.
Okay, thank you.
I think any other questions at the moment? Yeah.
Well, 2 minutes.
We'll find something else, a few things to go through.
Okay, how about, actually, I thought of one. How about insider ownership of the firm? So it looks like the owner of the insiders own pretty small percentage of it.
Yeah.
And that some major large institutions own the majority.
Mhm.
Is that a positive, negative?
Definitely a negative. When you have executives that aren't directly impacted by the company's performance, that's bad. Because then if the company performs bad or if it performs good, it's not really going to affect them at all. So if the company starts performing worse, they're not going to be directly impacted. So they're going to keep their same salary and they're not going to have that drive to continue to push the company forward. I imagine once they get a more diverse board of directors and a more diverse team, they'll probably start implementing a more implemented structure of having stock or something like that to kind of incentivize, good performance of the company.
When you were going through the valuation, were there any other valuation metrics that you looked at that you decided not to include?
In terms of what, like in terms of models?
Yeah, exactly. Any models, use, dividend discount, cash flow.
I would say specifically what I guess how I can kind of talk to this is we didn't really focus on more of the bigger investment banks. We focused more on the smaller investment banks as due to them being more comparable to HLI, and especially because HLI is more of it, even though it's been founded since 1972, it's been public since 2015, it's more of in its infancy. So by focusing on more infant companies or more smaller cap companies, you're going to get more of a better picture of the company.
And kind of thinking through that, from a competitive lens, are there other things that their competitors are doing that they aren't, or do you think they should be?
There are other competitors. They do have a more diverse management team, and at the same time, they do have their executive compensation doesn't include shares.
Okay.
Thank you.
Thank you.